All right. So, what is mortgage? What is a mortgage lending company? Well, welcome to the podcast Seeking Wisdom Through Real Estate, where we dig deeper into truly understanding and gaining knowledge from experienced and educated people. I am your host, Leah Massey. I'm a real estate agent who is trying to educate myself more and bring you along on the ride. For every week, we will be bringing you information to help you unlock the understanding in real estate. So join me today with Anthony DeLuca from Victorian Finance LLC.
Hi, thanks, Leah, for having me. It's great.
Great seeing you, Anthony. So, Anthony, you have years of experience in banking and lending. He has recently been named five-star mortgage professionals of Pittsburgh and the Realtors Association of Metropolitan Pittsburgh Affiliate of the Year. He specialized in rehab mortgage loans. He has been a guest presenter at Duquesne University School of Law, Community College of Allegheny County, and numerous Realtors Association of Metropolitan Pittsburgh. So, Anthony, busy. All right, so Anthony, so you started community banking in 1998. Can you take us along that journey to what it led up to now?
Sure. I started at a small community bank in Pittsburgh.
Mhm.
It's no longer, you know, out, out there anymore. But it was Allegheny Valley Bank where I got my
Okay.
start. I started as a bank teller, sales associate where I opened new accounts. I was an assistant manager, a branch manager, and then I did all their mortgage loans for a good many years. In 2011, I've moved to Victorian Finance just with a larger scale of products and options to help clients buy a house, refinance, really help, solve their financial needs.
Okay. So you really had climbed up the ladder then in banking. Yeah, and
Hmm.
lending. Yep. And then how about could you tell us about what exactly is mortgage lending company? And also a little bit, when I was researching, I seen about the Victorian story. So I don't know if you
Sure.
want to kind of talk about that too.
Yeah, so Victorian Finance, we're called
Hmm.
a correspondent mortgage lender.
Okay.
We're actually a lender. We have our own processing, underwriting. We close in Victorian Finance's name
Hmm.
and fund the actual transaction. The beauty of that is we have people in house that we can like pick up the phone and call them. Like we can talk to an underwriter, which is a huge advantage.
Hmm.
Where a broker is sometimes more like a middleman that's submitting a loan to a bank. We have the ways and means to approve the loan, fund the loan, and then transfer that loan in the secondary mortgage market, essentially building a mortgage-backed security.
Okay.
Um, as far as the mortgage banking companies, it just has so many different products, right? So we can look at conventional financing, FHA financing, USDA financing, VA financing. We have some specialty non-QM products. Non-QM is non-qualified mortgage products. So those are sometimes for self-employed people that use their bank statements to qualify instead of their tax returns, or investor loans where an investor can look at the cash flow of what that rental payment is. Does that cover the mortgage payment? So that's a type of loan that's out there that doesn't look at tax returns or other ways of income verification.
Oh, okay. So when you had mentioned too, you had mentioned about that there are differences between like a mortgage broker and then a bank. So you're similar to like a bank, but it's more of a private. How can you explain the difference a little bit with?
Sure. So really, a mortgage broker is kind of like the front end of the transaction, where they submit to a customer's package to a bank,
Hmm.
and then that bank approves it. Where that mortgage broker probably can't talk to the underwriter, can't help either massage the transaction to make sure
Yeah.
it's going to go through or find any pitfalls, anything
Yeah.
like that. So at Victorian Finance, we have our own in-house underwriting, which is a huge advantage. And then we can contact that underwriter if we have a question or clarification or something to that effect.
Okay. So
Um,
you're similar to like your franchise type banks that we're familiar with a lot of them, but it's just privately kind of. Is that?
Correct. And we also have like our CEO, Sonny Bringle,
Hmm.
is also the CEO of a small bank in Tennessee.
Hmm.
So they help us do some unique things for clients too, that maybe like a portfolio loan of some sort, or
Hmm.
or an interest only home equity line of credit is another popular product that bank can offer to help clients fit their needs.
Okay. And you had mentioned that you specialize in rehab, more so mortgage loans. I researched that.
Sure.
Can you talk a little bit about that?
Sure. So years ago, I learned renovation lending, which
Mm.
was two main products are the FHA 203K loan, which is
Mhm.
just the name of the code that the FHA uses for the renovation loan,
Okay.
and then the conventional loan has through Fannie Mae is called the home style renovation loan.
Mhm.
So these types of loans look at a budget of what do you need to do to a property either to fix it up or to make it the way you want it, right? So if you want new kitchens, bathrooms, or new flooring, or say you buy a rundown foreclosure that has holes in the walls and
Mm.
needs renovated. We get a big budget of all that stuff that you need to do. A licensed insured contractor has to sign up for the job. They get paid in stages as the work gets completed, but you can bundle this with a purchase transaction or a refinance transaction where a customer can either pay off their first mortgage with a refinance transaction,
Mhm.
then hold a chunk of money for the renovation budget,
Mhm.
or as a purchase transaction where you're buying a house,
Yeah.
get that whole budget of all the stuff you need to do to fix it up, and then package that as like the purchase price plus the renovation budget, add the two together for the total project cost,
Mhm.
and then we can lend off the total project cost.
Oh, okay. Is that pretty familiar? A lot of people do that. Is that I don't,
The hard part is the
okay.
contractor is the main variable that can really mess up a renovation project,
Okay.
unfortunately.
Okay.
So, not all contractors are licensed, insured, want paid in stages. So that's the other variable. And then the
Okay.
other tricky part is the time factor,
Mm.
right? If you have a client get under contract to purchase a house and you're going to close in 60 days, like how fast can you get a written detailed contractor estimate?
Oh, okay.
And then Mr. Appraiser looks at that detailed contractor estimate and says, okay, the future value of the house will be worth X based on this renovation project. So
Oh,
that's another component that is a big variable because if Mr. Appraiser says, okay, the project cost exceeds the appraised value, then the financing gets cut back, and then the client has to either bring more money to close.
oh,
So
okay.
it's
So
a
there's
balancing
okay.
act for sure.
Okay.
So
Okay. And is there something too? All the repairs and all that happens after the closing and
correct. So like on
okay.
a purchase transaction, the money we get funded for, say, the purchase price,
Mhm.
the money for the renovation project gets held in an escrow account to pay the contractor in stages. Typically, before the contractor is paid, there's an inspector,
Mhm.
usually Mr. Appraiser. We send him back out to inspect and say, okay, this portion of the work is done. Advance us a chunk of money, as a result to pay the contractor.
And what do you see through your experience? What do you see mainly people using that option for? Who are the people usually using that option?
Um,
Yeah.
it's typically those are like owner occupied properties, so
Okay.
like it's not really for investors. Like the
Okay. So
FHA loan
okay.
requires that you're owner occupied.
Mhm.
I think in some of the rules for Fannie Mae that the home style loan would allow an investor, but there's no banks that will buy an investor renovation loan.
Okay. Well, that's good to know.
So that's just the tricky part.
Okay. And you did mention too some of the different options that you guys offer at Victorian Finance. I
Sure.
did have a booklet, and this your home buying journey booklet.
Yeah,
It
that's
was
great.
very informative. And in here, it listed some of the things that and I think you kind of talked through some of the loans that you guys have, like the VA, VA, FAH, FHA.
hmm
Lord have mercy. Renovation, reverse. Can you talk a little bit about some of those loans, please?
Sure. So, conventional financing we can look at
Hmm.
through a Fannie Mae underwriting software or a Freddie Mac underwriting software.
Okay.
And some unique things that like occur with that
Mhm.
are, Fannie Mae for self-employed people usually wants a 2-year tax return average, where Freddie Mac would actually use just a 1-year tax return average or income for your income calculation if you're in the business for more than 5 years. So that can be a deal breaker sometimes if you have to average a client's tax returns over 2 years. They have a year and a low year. That could like disqualify them for a mortgage.
Okay.
So that's another one little nuance. FHA loans are great for first-time home buyers. We have
Mhm.
an FHA down payment assistance loan
Mhm.
where it's a first mortgage and a second mortgage, and you can get up to 101.5% financing. So 96.5% first mortgage as an FHA loan,
Mhm.
and then a 5% second mortgage. So it can really help clients that are short on funds to close and need a little extra help to get to the closing table by getting that first and second mortgage. And with that FHA loan, you can actually partner seller assist with that.
Mhm.
FHA loans permit up to 6% seller assist. So if you bundle seller assist and the down payment assistance loan, you can get a client into a house for very little money out of pocket.
Now, you mentioned 2 things, just so kind of explain for our viewers.
Sure.
You mentioned about Fannie Mac and, Freddie Mac. Can you explain this a little bit, if you
Sure.
may?
So Fannie Mae and Freddie Mac
Mhm,
are the government-sponsored entities.
mhm,
They essentially dictate the rules. They write the rule
yeah,
book for conventional financing. Fannie Mae uses Desktop Underwriter is the name of the underwriting software,
mhm,
where Freddie Mac uses Loan Prospector or LP is what they call that.
mhm,
So it's a matter of like knowing some criteria up front. Like you have a self-employed borrower, maybe it's better to go with Freddie Mac or LP the underwriting software.
mhm,
Another thing with those differences is if you have a shared driveways for Freddie Mac are fine. Fannie Mae wants a maintenance agreement for all the people that are sharing the driveway. Who's taking care of this driveway? So that can be a little tricky on things too. But if I know that going in, I would follow like the LP or the Freddie Mac software
oh, okay.
as a result.
And then how about you mentioned seller's assist.
Mhm.
Can you explain that a little bit?
Sure. So seller assist is where the seller gives back the buyer a credit to help pay for their closing costs.
Mhm,
On FHA loans, it's up to 6%. On conventional loans, up to like 3%. On say 95, 97% financing. But if the client puts 10% down, then they could get up to say 6%.
mhm,
So that's where, and then the seller takes less money for the house essentially. So if they're giving a seller credit of $5,000, they're going to take less of, say $5,000 from their proceeds
okay.
essentially.
And how much would you say, normally, on your do you suggest with buyers to have saved up for a down payment and closing costs? What would you
Sure. So typically, like it has become increasingly more expensive to buy a house.
Mhm,
The cost of homeowners insurance is really skyrocketed after natural disasters, fires. These insurance companies are just charging new clients that are trying to start a new premium or a new policy. So homeowners insurance has really gone up. Taxes are also a higher component of their mortgage.
mhm,
So depending on what neighborhood they're looking in, it can really make or break a deal sometimes, depending on the property taxes. As far as just like a ballpark
yeah,
number, maybe on $150,000 house or a $250,000 house, you might need like $10,000 to $15,000.
mhm,
Without seller assist. If you need some seller assist, you maybe can get into a house for less than that. Like I mentioned, that down payment assistance loan.
mhm,
Um, so
okay. And then you guys have the USDA loans too.
correct.
Can you explain that a little bit more?
Sure. So USDA
Mhm,
is the United States Department of Agriculture.
mhm,
They insure loans and they give up to 100% financing. The two main caveats with USDA loans are the house has to be in a rural area, and there's an eligibility map that you can punch in an address and look up, make sure it's in an eligible area. And then the other caveat is the household income. So they look at household income. In Western PA, it's usually like under maybe 90 to $100,000 in household income, and they look at all the adult people that are working in the house. So if you have adult children, they do look. They want their pay stubs or
mhm,
W-2s, that kind of thing, to make sure that your household income limit is under that limit for USDA financing. But
mhm.
USDA financing offers 100% financing, which is great. So you can get a client into a house for again little out of pocket.
And is that something usually the buyers will know when they're meeting with the lender? Like, whether that option's available or
Um, Typically, like I like to
okay.
bring it up if a client tells me, oh, I'm looking, because I like to usually ask, are you looking
Mhm,
at any certain school districts, any
mhm,
certain neighborhoods? And then once I hear that, like if it's a Westmoreland County or Washington County,
mhm,
that could definitely be an option. If they're in Allegheny County, there's not as many pockets in Allegheny County. There are some small pockets, like even in Plum Borough, which you wouldn't think is a rural area, but parts of Plum Borough are USDA eligible.
mhm,
Um, and even parts like Oakdale, I want to say there's some USDA eligible pockets out there.
okay,
Um, so yeah,
okay. And how about and the renovation loans are the same as the rehab, right?
yep,
Okay.
correct. Hmm.
And then the reverse mortgage?
Yeah, so our reverse mortgage, we have a special senior lending division
Uh-huh.
that handles nothing but reverse mortgages. Typically like the HECM loan or HECM
Mhm,
is the reverse mortgage where an elderly person, I believe, they have to be over age 62 and older to get the reverse mortgage, where no payments are then made on that mortgage. They can extract some of their equity so they can like live off that money or renovate their house or turn it into an annuity so they get a stream of income, and then there's no payments due on that mortgage when they pass away. Then the house gets disposed of, and and the mortgage gets paid off as a reverse mortgage.
Do you see a lot of people knowing about that?
Um, Especially in Western PA and
Yeah.
Allegheny County, we're one of the oldest, counties by age, I believe. So I
Mhm.
think that it can be a much more popular product as people want to either downsize or they don't want to downsize and they want to stay in their house. Reverse mortgage could be a great option for them.
Okay. And they can just go to their local lender and
Well,
bank and
call me.
yep,
We can get
yep.
them in play with our senior lending division. We have
Mhm.
a couple great guys that are handle just nothing but that because there's like specialty counseling.
Mhm.
They usually want to talk to the heirs of the estate to make sure that hey, we don't want to take advantage of any elderly
Okay,
clients as a
yeah,
result.
yeah.
Like do you know what you're getting yourself into
Mhm.
by putting your house up for a reverse mortgage?
Okay.
Just to like help educate them for sure.
Okay.
So.
And then you have the fixed rate and the adjustable rate. Can you talk about
Sure. So typically the bread and butter is 30-year fixed rate
yeah.
mortgages. You can do a 15, 20-year term if you want to shorten the term. But there's also adjustable rate mortgages. And there's a lot of different indexes they can go off of. But like an adjustable rate mortgage is typically fixed for, say, maybe the first 5 years, 7 years, or 10 years. And then after that 5, 7, or 10-year mark, the rate is then determined based on a margin plus an index.
Mhm.
So the indexes are like a LIBOR index or I'm trying to think some other, U.S. CMT Treasury
Mhm.
indexes, and then those indexes like it would reset. Maybe an ARM is good for that client that's moving to Pittsburgh, but hey, I don't plan to stay here for more than 5 years. So maybe an ARM might work
Mhm.
for them. But typically, the bread and butter is rule out the variableness with interest rates, lock in an interest rate.
Mhm.
If you buy a house in the state of Pennsylvania and it's your primary residence, there's no prepayment penalty on that loan, so you can always pay that off, or refinance that loan further down the road.
Oh, okay. And is when the buyers come in or when they're coming in or borrowers coming in trying to do they get in some credit counseling or whatever
Sure.
or just counseling in general to kind of know what exactly the best option is for them? How's that usually done when you meet with
So,
them?
so typically when we have a client apply,
Yeah.
we that when they make an online application, they grant their credit authorization to have their credit report pulled.
Mhm.
Typically, what we like to do at the early stages is we do a soft pull on their credit. So no credit inquiry appears. We get 2 out of their 3 credit scores. But the reason we were really doing that is due to the trigger leads. The credit bureau is selling that client data to mortgage lenders across the country, and then they're hit with 25 phone calls. So that's why we like doing that soft pull on the credit first to kind of give them a little feel, a basis of,
Mhm.
hey, this is how, like, can forecast how much house they can afford on a monthly payment. Just with their feedback, they can talk about how much money they wish to use for closing.
Mhm.
So that's the other main constraint. So payment and what you have for closing are the 2 main constraints that we can help guide them and box them in. And then if we pull their credit and it's not the greatest or they have some blemishes, let's work on it. Like
Mhm.
like I'll show you that information, what's reporting against you negatively,
Yeah.
and then either pay that stuff off, rectify it. Look at maybe a debt consolidation loan if you have to, or something to that effect, or a cash out refinance to consolidate debts is another option to improve their credit rating.
Okay. And I know, and I again, I really like this book. It was very informative. A lot of times too, I think there's confusion even when I sometimes have my buyers. Sometimes I've noticed some lenders will concentrate a lot more on the credit, and then some will see what the job. And I know they're all important to see what your employment is, see what the debt to income is. But
Hmm.
how is that like? What's really focused on first, if there is something that's focused on
Yeah,
first?
I think credit is probably the
Okay.
thing that, we order the credit report. Once a new application comes in, order the soft pull on the credit or a hard inquiry. If you have a client that is okay with doing the hard inquiry at the
Hmm.
start, or they're under contract and they want to move on something quick, then I would say let's do a hard inquiry. So the mortgage rules use the middle score of all 3 credit scores
Hmm.
and the lowest middle score of all borrowers on the loan. So if you have a husband and wife and one has a higher middle score and a lower middle score, you're going to use that lower middle score.
Okay.
Um, so that's kind of probably the main distinction. We look at that credit report, make sure the scores are acceptable because that's the main determining factor for interest rates.
Well, how
Um,
about as far as their employment? Say, I know you usually it's like 2 years.
Correct. So we
Okay.
have to verify a 2-year work history.
Yeah.
And then depending on that 2-year work history, if you've had multiple jobs, sometimes the income is averaged over a 2-year period. Or, if you're a salaried employee, it can be a little different. They would use your salary. If
Mhm.
you're self-employed, that gets another gray area. They look at your tax returns if you're self-employed for conventional and FHA and USDA and VA financing. Some of these non-QM products look at bank statements instead of tax returns, where clients can qualify based on if they're self-employed to use their business tax return or their business bank statements, add up all these deposits, and then they use a portion of that as your income.
Okay. So they may have a great credit score, but they also, with that income too, they have to have that has to be there. So all of it kind of
It
has to
all has
be,
to be
yeah.
there. It's
And then,
the different components to really get a loan. There's the collateral, the credit,
mm,
the income, the employment. So you kind of the funds needed to close. So those are all the main components that you really need to have all those organized to get a mortgage and purchase a house.
okay. Alrighty. And then also too, I since you guys are the mortgage lending company, you guys are like a bank, so you guys have your underwriter there and
Correct.
everything there,
We have a
and
team
you're
of underwriters, all kind of working out of some in Western Pennsylvania, but also kind of across the country with the pandemic.
mhm,
Working from remotely in the mortgage world is kind of commonplace anymore. It seems like so it helps us.
well, how's that process behind the scenes? Because I know like um, we have you have the lender, you have the loan officer, and then you have a processor.
Mhm.
So it kind of goes in different hands of people sometimes too, right?
Correct.
Can
So
you?
like
Yeah.
so typically like your the mortgage file flows through different departments
Mm-hmm.
essentially. So in the early stages, I'm a loan officer, mortgage loan originator,
Mm-hmm.
and I kind of help structure the deal. I'm also the face point of contact. I start pushing clients to submit their bank statements and their pay stubs and their
Mm-hmm.
W-2s or their tax returns. And gather all that information, and I'm starting to organize it in their loan file.
Mm-hmm.
Then typically I submit their loan to processing, and processing orders their appraisal and the title insurance documents. If they're buying a condo, they have to order the condominium documents or the condominium questionnaire.
Mm-hmm.
And so then the processor is essentially getting that stuff organized for the underwriter. And then the underwriter is the one that actually makes the credit decision. They say this loan is approved, and they're ordering underwriting software programs
Mm-hmm.
and following that to the T to meet the mortgage guidelines. And
Mm-hmm.
then the underwriter returns a commitment letter that says the loan has been approved subject to these final conditions. It's been conditionally approved,
Mm-hmm.
and sometimes maybe the appraisal's not in as of yet, so that the loan is subject to the appraisal coming in at the sales price, for instance, or the title insurance documents, or they want an updated pay stub, or they want clarification on what's this deposit on your bank statement. Typically deposits over 50% of your gross monthly income have to be
Mm-hmm.
verified. Where did this money come from?
Yeah.
Cash is also not acceptable for mortgages. We can't trace the source of cash.
Mm-hmm.
So if you have cash, you have to fully document how did you get this cash, either with a bill of sale if you sold some piece of property or a boat or a, a motorcycle or
Yeah.
something like
Yeah.
that. You have to really be able to document it.
Okay. And also too, there's you can get a gift
Correct.
during
So
before you go ahead.
yep. So gift finance, you can get a gift from family
Mm-hmm.
members, or you have to be able to prove a close personal relationship to the gift donor.
Mm.
So it could be like an uncle, an aunt, something to that effect. They can't usually say friend. It
Oh,
doesn't
okay.
work for for a
Mm-hmm.
gift donor. But you can get a gift from, and they just want to see the paper trail of, hey, this gift donor give you the money, right? So they write you a check. They shouldn't give you cash.
Okay.
Have them write a check, or even get a cashier's check or a wire transfer, or if they both bank at the same bank, an automatic bank transfer can be fine. But they just want to have that. And then there's also a letter that's documented, the gift letter, that says, I, the gift donor, am not expecting any repayment of this money.
Mm-hmm.
So just as a way to use that. And then those funds can be used for down payment and closing.
Is that the only thing that's required from the gift donor? Do they have to give other personal information?
Not typically. It
Okay.
depends on kind of the means of how they're transferring the money. It's gotten a little more lax. In years past, they wanted the gift donor's bank statement
Mm-hmm.
that shows, hey, this money, okay, the check 123 cleared their bank account, and they want to see that bank account statement that shows the gift donor check has cleared their bank account, just
Mm-hmm.
as a way. Because sometimes, the fraudsters have faked those gift
Yeah.
checks, or and there was no paper trail, no follow up to see how was this gift donor able to fund this money over.
And is that usually just for usually the down payment and maybe some closing costs, or what's that usually?
It
Or
could
could be on
entail
a
it
loan
could
too?
yeah it can entail as much as they want. All right,
Okay.
so there's different rules now. If the gift donor is trying to write that off on their income taxes as a gift,
Mhm.
they have to follow IRS rules.
Right.
But if a parent wants to gift their child $100,000 to use for a house purchase because they're saying sometimes it's like early inheritance,
Uh-huh.
that person could use that $100,000 to use for down payment and closing and get into the house as a result.
Oh,
So.
okay. You find people do that a lot?
Lately, yes, more and more.
Mhm.
Maybe it's people just don't have enough money saved up for, and maybe the parents want their kids out of their house,
Mhm,
right?
yeah,
So
yeah.
so they look at that as a feasible option to do that
Yeah.
and give their kids maybe this early inheritance and then use that for a down payment on a house.
Oh,
You know?
okay. Yeah. For people who don't know, that's an option too, yeah, if you
Hmm.
don't have the money saved. And then, the other thing too is I noticed, Victorian Finances also has some other things like marketing. You have marketing and
Sure,
press and print.
we have
Yeah.
a marketing department, like they've
Uh,
created that booklet.
oh, okay.
They also do a lot of different flyers, for either realtors for like open houses, for instance, or
Mhm.
just different loan products, just to kind of get that, the word out there of, hey, these options are out here and available to clients looking to buy a house.
Oh, okay.
We also have like a high tech printing machine. That's how we can make all these booklets and flyers. So that's how they complete that
Mhm.
uh, for us as well.
Is that offered to the client too? Or is it just
Um,
the
it's mainly
agents?
for like
Agent
marketing
for the agent.
for
Okay.
agents and realtors, maybe even CPAs or divorce attorneys, something like that. If they needed something specific, we'd be happy to print some documents for them as well.
Okay. So that's like a separate service that you guys offer. Okay,
Hmm.
I like that. So also too, so we went through the different loan officers and processors and underwriters. Also too, I wanted to go back to that real quick. Does the client ever get to speak or interact with the processor or the underwriter?
Never really with the underwriter. That's
Mhm,
kind of like the sealed away part of, the underwriter is supposed to be making an objective credit decision based on all the documentation they have in front of them.
mhm.
So they can't say, oh, well, please approve my loan, get the sob
Yeah.
story, from the client to approve their loan, for instance.
Mhm,
So really there's no communication with the underwriter. Me as a loan officer, I can contact the underwriter to get a clarification on something, or they give us back a commitment letter that says this condition
mhm,
and we're not exactly clear on it. So I could pick up the phone and call them or send them an instant message or an email, something to that effect, to get it clarification on that. Or there's some piece of documentation that we get back in, we're unsure on the interpretation of this, so we could send that to the underwriter to get clarification on that.
yeah, okay. And what are some of the common things that usually once it gets to underwriting, it doesn't go through?
Um, appraised values are a big variable, right?
Mhm,
So when we don't know what that house is going to appraise for, is it going to appraise higher than the sales price or lower than the sales price? If it appraises lower than the sales price, then the financing is cut back.
mhm,
The financing is structured off of the appraised value or purchase price, whichever is less,
mhm,
is the key little
mhm,
word in the sentence. So probably appraised values are a big variable that we don't know until that appraisal comes in. As far as like underwriting, source
mhm,
deposits, when they look at conventional loans and they look at deposits over 50% of your gross monthly income. So, say the borrowers have combined $10,000 in just gross monthly income, they're going to look at deposits over $5,000 and more.
mhm,
So, like, where did this $5,000 deposit come from? So you have to be able to provide documentation for that.
mhm,
So those are probably the biggest things that we're kind of like looking at once the commitment letter comes back, and we're trying to chase down these deposits, verify this.
mhm.
So it's kind of
And when it comes down lower in value on appraisal, can't the buyer kind of put in that money if they really want the home? If they can
correct.
have.
So like, and sometimes we can also change the financing, right?
Mm-hmm,
So say a client's putting 20% down on a house.
mm-hmm,
But then the house under appraises.
mm-hmm,
Maybe we change the financing to 90%, and the client still brings the same amount of money and just finances more, but we're going to structure their 90% financing off of that lower appraised value instead of the sales price.
yeah.
So it can be offset. Where it can hurt a little bit is sometimes if you're doing maybe conventional 97% maximum financing for a client and they're pinching every penny to get into the house and then it appraises lower, then that's could be a problem, because then we have to come back to the client and do the math. Hey, this is what you're going to need to bring to closing. Is this feasible? Or sometimes maybe you negotiate that out with the buyers and sellers and see if they can come to some middle ground, maybe split the difference
Yeah.
on a low value, for instance.
And are you seeing sometimes when it appraises undervalue, is that a lot of times because people are making bids higher? Is that usually or what
Not necessarily.
okay.
So, like, it was kind of crazy in the pandemic years
Mhm.
when people were bidding way over the list price of a house, and it was appraising,
Yeah.
just
Yeah.
because there was such demand,
Mhm.
and rates were really low, and it was just really affordable at that time.
Mhm.
Now rates are up a little bit more, and it's making the affordability a main issue for new clients trying to get approved for a mortgage because the rates are higher, the payments are higher.
Yeah.
Not many clients want a $3,000 to $4,000 mortgage payment per month.
Yeah,
They want something
yeah.
more affordable.
Right, right. Are you still seeing people buying and selling? Are you still seeing getting
We're
bids
seeing
back?
it. I think there's still some more inquiries, but there's also like I kind of call it an education process,
Mhm.
right? I'm educating clients. Like you talk to a first time home buyer, maybe they say I want my payment to be $2,000 a month max. Well, that might not get them as much house as they think that they can afford.
Right.
Unfortunately, so it's just a matter of educating them on some of the numbers and and their comfort level for what can they afford, what can they pay for each month, and how much money they have for closing.
That's a good point too, because sometimes you might be approved for a higher number. It doesn't mean that you have to get that amount of house. You got to think of
Correct.
all the other stuff.
All the other
Can you explain
stuff,
that a little bit? Like, I
sure.
think,
So typically we can approve you for maybe more housing you're comfortable with for
right.
a lot of clients,
Hmm.
and it's more just a comfort level. So it's me having that initial conversation, just asking, what's your comfort level? What do you want your payment around? Is a good way to kind of put it. And
Hmm.
then once you have that feedback, sometimes I've pre-approved a client recently for like a $300,000 or $400,000 house, and they're like, "Whoa, that's way too much for me. We want our payment way lower,
Hmm.
around a 250 house, for instance." So it's just a matter of that comfort level, um, in analyzing that.
Okay. And then also too, um, what would you say that what would you why do you think people should choose mortgage lending company or Victorian
Or Victorian.
finance? Yes.
I have a couple of reasons. So,
Okay.
one, I really pride myself in what I do. I help
Mhm.
people buy houses.
Mhm.
I work 7 days a week. When people see houses on Saturday and Sunday, and they need a pre-approval letter, or they want some numbers, I'm happy to help them. So I go above and beyond to really help my clients buy that house. And those little details, sometimes at a bank that's open Monday through Friday, you're not going to get their loan officer on the weekend. Number two, the ease of, like, our process that we've made, where like I'm the intake person, the initial contact.
Mhm.
We get their loan approved quickly, and there's no variables that we don't know about that we aren't going to tell you about, right?
Mhm.
So we want to be truthful and honest, and get you quick turnaround times. And really the goal is, if we close early, let's do it, right?
Mhm.
As a product, as a really just the objective.
Yeah.
Um, I think the ease of underwriting is also
Mhm.
having that accessibility to talk to our underwriters, that can help clarify points, as opposed to sending an email to a bank, waiting 3 to 4 days for an answer back, and then
Mhm.
you go back to the client, then they don't give you exactly what you need, and then you got to go back and you wasted more days and days. So that could be very frustrating on the client aspect.
Mhm.
But I think we've solved that as a way of having that internal underwriting as a way to solve that problem. Um,
Yeah, and that is a good point. Yeah, you have it all in house.
mhm.
And then also too, I just wanted to also ask about since you had been a presenter at different colleges and different realtor places. Why do you do that? Why do you enjoy educating people about mortgage?
Really, I think that's just my day-to-day job, right? So
Mhm.
I could talk to realtors about it. I could
Mhm.
talk to attorneys about it. I could talk to clients about it.
Yeah.
And just to kind of help educate them, get them truthful, honest information. People, especially first-time homebuyers, they're nervous. They're
Mhm.
like, they never bought a house before. They need someone that can help guide them, help answer their
Yeah.
questions, and they're just unsure of things, right? Or they
Mhm.
read stuff on the internet that's maybe not true. So, like, call me, talk, text me, email me, whatever's good. I'm happy to, help clarify points, or, I've been doing this a long time, and I'm happy to. I've seen a lot of crazy scenarios and
Uh,
transactions, and I don't know, it's just given me some great experience to solve problems, right?
yeah.
And it's not like it's solving the problems quicker, right? So
Mhm.
it's trying to be able to like don't hold that from a client and don't tell them until the day of closing. Oh my God, no! Like
Oh,
as
yeah.
soon as you get a commitment letter, get that stuff out the door.
Yeah.
Say, okay, here's the list from the underwriter. This is what we need to work on. This is what we need paperwork for. This is what we need to clarify.
Mhm.
Oh, this is what we got to chase down for that, and then get that stuff back into the underwriter so you can get your file clear to close.
Yeah.
So I think the big no from loan officers is don't hold back on, oh, well, maybe they're going to waive that requirement. No, they're probably not, right? It's
Right.
solve the problem, be truthful, be honest, and come forward. Like we need clarification on your previous employment, or it says you were fired for this reason, or what, just something to that effect. So,
Yeah. And I appreciate that. That's definitely that truthfulness and communication along the way. The
hmm
clients appreciate it too. It helps the process, everybody involved.
yeah, because we want to get to the goal of closing day,
Yes.
right? We want to close. We want to close on time. The contingencies that happen when you don't close on time, you have painters lined up or movers lined up, and then like that could cost thousands of dollars, or your transaction's contingent on another transaction that you're messing up another family because you're not closing on time to
Right.
is buying your house and you're selling your house. It can snowball out of control.
Yeah. I think I seen something on Facebook where they had mentioned about the behind the scenes with realtors and like everybody on the team, either even lenders, that all the fires you're putting out, all the things that's going on behind the scenes to get to that close. They
Sure.
only knew. Yeah. And then I did see when you had mentioned about your response time and then your attention to detail or your strengths. So that's good because that's definitely needed in this field. And I did see some of the good reviews and everything like that.
Oh,
So some of the
great.
things you're saying, definitely people were saying that as
Honestly,
well.
that's what makes me feel so
Yeah.
good is like after, you're maybe stressed or waiting on underwriting,
Yeah.
are they going to accept what you provided? And you're
Hmm.
just waiting and waiting. And then you get that clear to close. It's like, that relief. But then after the closing, when you get a client reviews you and gives you like 5 stars and
Hmm.
says great things about you, that's what like really gives you goosebumps and makes you feel good about
Yeah.
your job and re-energizes you to help the next client and
Yeah.
to either buy a house or refinance or whatever,
Yeah. And those things get you through. It's
Yep.
like it comes at the right time. It's like, okay, I'm
Yep.
doing it. So what do you want the viewers to remember and take away from today's interview?
Um, Give me a call, right? So,
Hmm.
I'm happy to help. I want to help anyone either in whatever stage of the house buying process they're in, if they're in the early stages, if they're just throwing this out as an idea, if they need some credit repair help. I'm happy to help you, right? So that this is just what I do for a living. It's a cool job that I get to help people buy houses, right?
Yeah.
So, and I'll tell it to you straight. I'll, won't lie to you and
Hmm.
want to get you honest, truthful information
Yeah.
and deliver on our promise to get you this new house.
Yeah. And you're definitely, Anthony, you're definitely approachable because when I called you, I mean, you were very friendly and nice, almost like we were old friends.
Yeah.
So I really enjoyed that about you.
Sure.
How can people get a hold of you?
Right on my website's probably the best spot, right?
Uh-huh.
So it has my cell phone number on there. So I do get a lot of spam calls with having your
Okay.
cell phone number on the
Yeah.
internet.
Yeah.
But anthonydeluca.victorianfinance.com is my
Mhm.
website. You can apply, make an online application. That online application grants the credit authorization for me to order your credit report and credit scores.
Mhm.
It meets all the government rules for corresponding electronically. It securely encrypts your data. At the end of the application, you can upload your documents if you have documents handy on your computer, like pay
Mhm.
stubs or W-2s, bank statements, that kind of thing. So that's a great way to contact me. Also on my website it has a bunch of the scrolling reviews from past clients, from
Mhm.
realtors. Check that stuff out. Like it makes me feel so good just reading it.
Mhm.
Typically when the client submits that review, I get an email and it's like, wow, like look what they wrote about me.
Yeah.
It really makes you feel good and like I said, re-energizes you to do more and
Mhm.
help more clients out there.
Yeah. And I always ask, since this is seeking wisdom through real estate, what's a piece of wisdom that you would like to give everyone?
Piece of wisdom. Be truthful and honest. That'd
Mm.
probably be the best thing to do. When
Mhm.
a buyer hides or a buyer lies about something, it's going to come back to bite you,
Yeah.
right? So be truthful and honest. I'll always be truthful and honest with clients. Hey, like maybe we should, we shouldn't put this in your loan file, but you may have to put this in your loan file. It's not good to like conceal things.
Right.
So being truthful and honest, maybe it's just writing a simple explanation letter to explain maybe this misnomer or whatever
Mhm.
that's a blemish on your loan file, something to that effect. So I think be truthful and honest, and it'll pay dividends further down the road for sure.
Yeah. I like that. All right. So, if you have enjoyed your time with us, please like and subscribe to this channel. See you next week when we seek more wisdom through real estate. God bless.